So today I want to talk about Fundrise. If you didn't know, Fundrise is a crowdfunding company that allows you to invest your money into REITs, which are real estate investment trusts that Fundrise themselves overlook. And so it has been a year and a month since I started investing with Fundrise, and I want to talk about my returns over the past 13 months and if I believe they will be able to keep growing this money. Now, this time has been actually very interesting since in late March we got hit with the Rona that pretty much shut down a lot of the REITs and REITs in general. But Fundrise, being a company that can alter their portfolio of which real estate companies they invest in, kind of changed it so that they were able to minimize their losses and kind of secure themselves for this period. So I will also talk about what they are doing to increase returns during this uncertain time. So to begin, there are 3 different core plans within Fundrise that you can invest in. The first one is supplemental income, which is focused more on attractive income streams in a way of dividends. So your dividends will be higher every quarter. And this will pretty much guarantee you a steady increase, as you can see by the linear graph of the target return. The second investment plan is a balanced investing plan, which is in between growth and income in the form of dividends. As you can see by the target return, it slows down, or it's kind of linear at first, and then it gets kind of parabolic towards the end. And then the last one is long-term growth, which pretty much has the slowest dividends every quarter, but the total return and appreciation towards the end is much higher than the other 2 plans. So the plan I chose was the balanced investing one. So that is my portfolio that you are going to see. Now keep in mind that using Fundrise, your funds are locked in for a period of 5 years. Now I say that locked with quotations because you can pull your money out, but it is not the most liquid and fast thing to do. By that I mean that there are costs by redeeming your shares, basically meaning selling them and trying to get cash out. So when you first start, you have 90 days to receive your full initial purchase price back. After those 90 days, they are locked for the next 5 years. So after 5 years, you are guaranteed 100% of whatever the shares are worth. However, if you want to cash out before then, you're going to be hit with a penalty that increases by 1%. So if you want to take your shares out within 90 days to 3 years, you're going to pay a 3% fee of whatever all your shares are worth. Between 3 to 4 years, it bumps down to 2%. And if you're trying to cash out that last year before hitting 5 years, you're just going to get hit with the 1%. So by this, it kind of makes it seem like you need to stay the course those 5 years. So from here, I can tell you, Fundrise is not for the investor that wants to put money in 1 month and then take it out the next. So this is one of the major cons of Fundrise, that you get penalized for taking shares out earlier. Whereas if you trade any REITs on any market, you can buy them at any price and sell them at any price without fees. But enough about the fees. Now I want to talk about my plan and my personal returns. So I started in June 3rd, I believe, of 2019, and I added $1,000 to my account, with the investment plan being balanced investing. It says May, but I think I funded my account in June. I think I logged in at the end of May, but I funded it towards the end of June. So you can see since then, my all-time dividends have been $91.25. The shares I've accumulated have appreciated $34.86. And in a year, I've paid fees totaling $1.76. So if we look deeper into my annual returns all time, it has been 6.5% for all reporting statuses and 6.9% for those. We can even break them down within each reporting net asset value, and you could see the spread of some that have actually netted as high as 15.8%, but also some that are as low as 0.6, 1.3%, 1.2%. This one's actually negative 0.4%. But these ones have not fully operated. Now, the website is very user-friendly, very colorful, and displays what you want to see whenever you want to see it. The app is also very intuitive. This kind of linear historical account value going up, and each step is when pretty much I added money to the account. I think I started adding $100 every month, and then recent months I started adding $150 every month. It's called auto investing, and it's a feature that they allow you to invest, however much money you want every month, and then it automatically adds shares to your account. The most recent thing you're going to see here in your activity is the latest update, news, dividend of whatever property they're buying. So for me, the latest one is the Brooklyn apartment renovation pays back successfully. And if you click it, it can show you pictures as well as numbers, and even gives you a timeline of all the projects. So that's just one. If it keeps going down, there's going to be more updates as they acquired or successfully paid back or even sold properties, as well as the occasional news article. So my portfolio right now stands at $2,574 with 35 cents. There are two types of properties, equity and then debt. Equity stands for properties that they own, as in they own X amount of properties and that money is theirs, right? Because they own the property. Whereas debt means that they financed or loaned out money to other people to fund their real estate projects, renovations, things like that, and are making money from that loan. Most of the equity properties that Fundrise does own are residential properties, and so the money we earn through growth is while that property, increases in value, but as well as rent gets paid, and that is the money we make as well. There's also different Fundrise ratings, A, B, C, D, E, and they go from the safest to the most riskiest. The most riskiest ones do have the higher return. As you can see here, I'm fairly balanced with more around B and C and within D. And there are even 5 scales between, each letter. So with the Rona, having decimated a lot of the real estate investments in recent months, Fundrise has changed their portfolio in a recent article that they put out stating that 70% or nearly 70% of their portfolio is held in residential rental properties, the vast majority of which are focused on providing well-located and reasonably priced housing to workforce renters. Now, this is very important because any other REIT is focused on one specific type, such as malls, factories, or even like elderly housing, just like that. And that is all that they're focused on. So those have been, decimated by the Rona here recently, whereas Fundrise can change what they focus on at any given time. And in this time, they're focusing more on rental properties, as it seems to be the safest approach. Another article that they posted is about how they plan to invest throughout the crisis, because people are obviously still looking to invest money. So while we invest money into Fundrise, we give them the money and they, do with it as they see fit to put it in whatever property they want. So they're doing 3 phases. They're going to maximize near-term flexibility with target investments being in public markets and structured debt. That is the first phase. The second phase is to maintain stability, increase yield, targeting distressed debt and private market rescue loans. And the phase 3 is capitalize on opportunities for higher potential return, which means undervalued properties that they intend to hold longer term. What this means is the private market rescue/bridge loans are when they come in and help somebody else finish a loan. So for example, if somebody has a building, like a apartment building that they were halfway through being finished, right? When they are making the loan payments, they still need to pay their creditors every month, even if the building's not done. And so in times like these, sometimes they can't make those payments. And if they do default on that loan, they lose everything. They lose all the progress on the apartment they were building. And if you couldn't tell by now, a half-empty apartment isn't really worth much, right? So what Fundrise can do is refinance whatever loan they're working on, or even give them however much money they want at a higher rate because the person is desperate to finish the house, right? So they're willing to spend a little more money to have something at the end that they have equity in. And so those are the rescue/bridge loans that they're talking about. Lastly, the undervalued properties they're talking about is better shown in this graph, where real estate buying opportunities lag the broader market. And they were saying that even after the Great Recession would happen, between 2007 and 2009, the buying opportunities happened a little after that. So towards the end of the recession is what I'm saying. So if we are in a recession that lasts, for a year, maybe longer, the best buying opportunities for properties will be towards the end of that, not towards the beginning. So they are, saving money to make those smart investments towards the end. With Fundrise, the longer you are into it, the more money you make over time. And that is the beauty, of compounding. With the dividends you make, you just reinvest them. All right, so lastly, I want to show you that they have around almost $5 billion in real estate. And this graph shows how much they have returned over time. So in 2014, they made 12.25%, 2015, 12.42%, 2016, 8.76%, 2017, 11.44%, 2018, 9.11%, 2019, 9.43%. So it does look like it's going down, but if you were into it this whole time, you would have gotten a lot of return. Basically, I believe the average for the S&P is around 7% every year. And the S&P this year is looking a little rough, so who knows what's going to happen, right? There's a performance analysis done with Fundrise where they're up 2.41% versus the stock market, which has been down 4.91%, and the total stock market VTI, and even the public REIT ETF, VNQ, has been down 15% in the first half of the year. So you can see how Fundrise is fairly stable in compared to other real estate investments. The main drawback, though, is that you have to keep your shares in there for at least five years, right? So my advice to you is if you have some money that you want to invest in real estate, long term, I'm talking about those 5 years, then you are safe to go with Fundrise. I believe they have proven themselves within, the past 6 years of being able to return money, and I do trust them to get through this pandemic and come out even stronger at the end. So I wouldn't invest, a whole lot of money in here because, you may need some money in an emergency. But if you have a little bit extra income that you can afford to leave sitting there for 5 years, definitely go with Fundrise. And even if you can add every year, go ahead and do it. If you guys want, maybe I'll do a review 2 years, which will be, a whole year after this. We'll see how that goes. All right, if you guys enjoyed, leave a like. If you are investing with Fundrise, leave a comment, and if you are even thinking about Fundrise, let me know why you haven't jumped on it yet, and what are your thoughts and doubts about it. All right, till next, guys.